Well, ladies and gentlemen, if you think you've seen big moves in gold and silver this year, you have no idea what's coming next. This isn't just another market update. This is a price alert of historic proportions. The charts, the macro forces, and the fundamentals are all screaming the same message. We are on the brink of something unbelievable. What we are witnessing right now in the precious metals market is not a normal rally. And it's important to understand that distinction. Gold and silver are not simply drifting higher because of short-term news or speculative excitement. They are breaking out of long-term structures that have taken years to form. When markets spend that much time building a base, the move that follows is rarely small. This is the kind of environment where price stops asking for permission and starts trending with authority. Gold pushing into new territory is a message from the market itself, and the message is very clear. Capital is rotating, confidence is shifting, and investors are quietly repositioning for what comes next. For a long time, precious metals moved sideways while other asset classes grabbed the spotlight. Stocks were the only game in town. Risk was rewarded and safety was ignored. But markets move in cycles, and those cycles always turn when complacency becomes widespread. What we are seeing now is the early to middle phase of a trend reversal that began quietly and is now gaining undeniable momentum. Gold has broken above levels that capped price for years, and silver is following with increasing strength. These are not emotional spikes. These are technical breakouts supported by volume structure and sustained follow-through. When price clears a major resistance zone that has been tested multiple times, it tells us that supply has been absorbed. Sellers who once controlled that area are no longer present, and buyers are stepping in with conviction. That's exactly what this market is showing. Each pullback is becoming more shallow, each consolidation tighter, and each push higher more decisive. This is classic trend behavior. Investors who wait for confirmation after the move becomes obvious often find themselves chasing price instead of positioning early. The market rewards those who understand structure, not headline. Gold leading the move is not surprising. It is the anchor of the precious metal space the asset institutions turn to when uncertainty rises and confidence in paper systems weakens. What is surprising to many is how persistent this move has been. There is no blow-off top behavior, no parabolic exhaustion. Instead, we are seeing controlled advances, pauses, and renewed pushes higher. That tells us this trend has depth. It tells us there is still fuel left in the tank. Silver, on the other hand, tends to lag early and then accelerate later. That's the nature of a thinner, more volatile market. When silver starts to confirm gold's strength, it often signals that the move is expanding, not ending. Silver doesn't whisper, it moves fast when momentum takes hold. The current setup suggests that silver is transitioning from accumulation into expansion. That phase can be uncomfortable for those on the sidelines because price doesn't wait for consensus. It moves when the structure demands it. What makes this breakout especially important is the broader market context, and we are not looking at gold and silver in isolation. We are seeing relative strength emerge compared to other assets. When precious metals outperform equities on a rate basis, it signals a shift in risk app. It suggests that capital is becoming more defensive, more selective, and more focused on preservation as well as opportunity. These transitions don't happen overnight, but once they begin, they tend to persist longer than most people expect. Another key factor is psychology. Many investors still don't believe in this move. Skepticism remains high, and that's exactly what healthy trends feed on. Strong markets climb walls of worry. If everyone was bullish, the risk would be much higher. Instead, doubt is providing the fuel. Each breakout forces another group of skeptics to reassess, and that reassessment often leads to fresh buying pressure. The most important takeaway here is this. Breakouts from long-term bases are rare, and they matter. They often mark the beginning of multi-year advances, not short-term trades. Whether you are an active trader or a long-term investor, ignoring these signals can be costly. The market is not asking for attention. It is demanding it. Gold and silver are sending a clear alert through price action alone, and price is the final authority. This is not about fear, it's about awareness. It's about recognizing when the market environment is changing and adapting before the crowd catches on. The breakout we are seeing now is not unbelievable because it's irrational. It's unbelievable because it's powerful, disciplined, and backed by structure. And those are the kinds of moves that tend to redefine expectations for years, not weeks. One of the most misunderstood aspects of major moves in gold and silver is the belief that they happen suddenly. In reality, these moves are the result of pressure building beneath the surface for a very long time. Markets don't react to headlines the way people think they do. They react to shifts in confidence, liquidity, and expectations. Right now, those shifts are becoming impossible to ignore. Capital is starting to question stability, not just in one country or one currency, but across the global financial system. That questioning is subtle at first, and it becomes visible through price, and eventually it becomes obvious to everyone. Gold and silver are responding to that early phase right now. When investors feel comfortable, they chase growth and risk. When comfort fades even slightly, capital begins to move defensively. That doesn't mean panic, it means recalibration. We are seeing that recalibration unfold as inflation remains persistent. Debt levels continue to expand and confidence in long-term monetary discipline weakens. These forces don't show up overnight, but they compound over time. Gold and silver thrive in environments where trust in policy, currency, and financial stability starts to erode, even if that erosion is slow and quiet. Jaddy interest rate expectations play a major role in this transition. For years, rising rates created headwinds for precious metals, but markets are forward-looking, not backward-looking. As expectations shift toward rate stabilization or eventual easing, the opportunity cost of holding metals decreases. Investors don't wait for the first rate cut to position themselves. They move when the probability curve changes. That shift in expectations is already being reflected in price. Gold doesn't wait for permission. It moves when the math starts to favor it. Currency dynamics are another critical piece of the puzzle. A strong currency can suppress precious metals for a time, but sustained strength is difficult to maintain when debt expands faster than productivity. When confidence in purchasing power weakens, even marginally investors look for assets that cannot be printed or diluted. Gold and silver represent certainty in a system built on promises. That's not an emotional argument. It's a structural one. Over long periods, capital respects scarcity. Geopolitical uncertainty adds another layer, but it's often misunderstood. Markets don't react to every headline or conflict. They react when uncertainty becomes persistent and unpredictable. When global tensions remain elevated for extended periods, investors begin to price in risk premiums. Gold, in particular, acts as a neutral asset in an increasingly polarized world. It doesn't carry counterparty risk. It doesn't depend on political alignment. That neutrality becomes valuable when predictability fades. What's important to understand is that safe haven demand doesn't arrive all at once. It starts with institutions quietly increasing exposure, adjusting allocations, and hedging long-term risk. Retail investors usually come later after price confirms the trend. That's why early stages of these moves often feel uncomfortable or unconvincing. The narrative hasn't caught up yet, but price already has. Markets lead perception, not the other way around. Silver adds an interesting dimension to this environment. While gold responds primarily to monetary and confidence-driven forces, silver straddles the line between a monetary metal and an industrial one. That dual role means it can lag initially, but once economic and monetary themes align, silver can move aggressively. When investors start to view silver not just as an industrial input, but as an undervalued monetary asset, the repricing can be sharp. That shift often happens quickly and without warning. Another key factor is correlation. During periods of stress or transition, correlations between assets tend to rise. Stocks that once provided diversification begin to move together. That's when investors rediscover the value of assets that behave differently. Gold and silver don't need economic growth to perform. They need uncertainty and balance and change. Those conditions are becoming more prevalent, not less. This environment doesn't suggest an imminent collapse or crisis. It suggests a long-term adjustment. Markets are transitioning from a period of extreme confidence in growth and liquidity to one of caution, selectivity, and preservation. That transition favors assets that have survived every monetary regime in history. Gold and silver don't rely on forecasts, they rely on trust, and trust is becoming more valuable. The message from the market is subtle but consistent. Safe haven demand is not about fear, it's about preparation. Investors positioning now are not reacting late, they are responding early. This is how major trends begin. Not with headlines and hype, but with quiet shifts in capital that eventually reshape the entire landscape. One of the most reliable ways to understand where a market is going is to stop listening to opinions and start watching behavior. Price action reflects collective decision-making in real time. And right now, the behavior of gold and silver is telling a very specific story. This is not random movement, and it is not driven by short-term speculation. The structure forming beneath these markets suggests intention, patience, and control. When you see price respecting higher lows, compressing into tight ranges, and then pushing through resistance with follow-through, that is the market revealing its hand. Technical patterns are often dismissed as abstract or subjective, but the reality is that they are visual representations of supply and demand. A multi-year resistance level exists because sellers have consistently been willing to step in at that price. When price finally pushes through and holds above that zone, it means something has changed. Either sellers are exhausted or buyers are more motivated. In most cases, it's both. That transition marks the beginning of a new phase, not the end of a move. Gold's recent behavior fits this model almost perfectly. The market spent an extended period consolidating, absorbing supply, and shaking out weak hands. Volatility contracted, momentum stabilized, and price began to coil. These conditions rarely precede a breakdown. They typically precede expansion. When the breakout occurred, it wasn't explosive or emotional. It was controlled, steady, and persistent. That kind of movement suggests institutional participation rather than speculative frenzy. What follows a clean breakout is often misunderstood. Many expect an immediate vertical move, but strong trends tend to advance in stages. Price moves higher, pauses, consolidates, and then continues. These pauses are not signs of weakness, they are signs of strength. They allow the market to reset momentum, attract new buyers, and establish higher support levels. Each consolidation above former resistance reinforces the bullish structure and reduces downside risk. Silver is beginning to show similar characteristics, although with its own personality. Silver's volatility is higher, and its movements are often sharper, but the technical foundation is becoming more apparent. We are seeing compression patterns that suggest energy is building. When silver transitions from consolidation to expansion, it rarely does so quietly. The key is res the setup before the move becomes obvious. Momentum indicators add another layer of confirmation. In healthy trends, momentum does not collapse during pullbacks. It remains elevated, reflecting underlying strength. That's exactly what we're seeing. Pullbacks are shallow and recoveries are swift. This tells us that buyers are stepping in earlier and with more confidence. That behavior is characteristic of trending markets, not topping ones. Volume also plays a crucial role. Breakouts supported by increasing volume indicate commitment. They show that participation is broadening rather than narrowing. In both gold and silver, volume patterns suggest accumulation rather than distribution. This is not the footprint of smart money exiting, it's the footprint of smart money positioning. Another important technical factor is relative strength. When gold and silver begin to outperform other asset classes on a relative basis, it signals a change in leadership. Markets rotate, capital flows from overextended areas into underappreciated ones. Relative strength is one of the earliest indicators of that rotation. It often appears before narratives shift or analysts update their forecasts. It's also important to recognize what we are not seeing. We are not seeing parabolic moves, extreme sentiment, or emotional spikes. Those are typically associated with latest stage rallies. Instead, we are seeing discipline. We are seeing structure. We are seeing a market that is advancing because it can, not because it's being pushed by hype. Technical analysis doesn't predict the future with certainty, but it does provide probabilities. Right now, the probabilities favor continuation, not reversal. The trend is up, momentum supports it, and structure confirms it. Ignoring these signals because they don't align with personal bias or outdated narratives can be costly. The market doesn't need validation from commentators or headlines. It validates itself through price. Gold and silver are not making noise, they are making progress. And progress, when sustained and structured, tends to carry it much farther than most people expect. This is how meaningful trends develop, quietly, methodically, and right in front of those who are willing to pay attention. Silver has always been the misunderstood metal. It lives in the shadow of gold. Yet, when conditions align, it has a tendency to move with far more intensity. That is not speculation. It is a structural reality of a smaller, thinner market where shifts in demand can have outsized effects on price. What makes the current environment especially compelling is that silver is no longer being pulled in two opposite directions. Its industrial role and its monetary role are beginning to reinforce each other, and that alignment is where the most powerful moves tend to originate. For much of the cycle, silver lagged while gold established leadership. That behavior is typical. Gold attracts capital first because it is perceived as stability. Silver, by contrast, is often viewed as volatile and secondary. But markets don't reward perceptions. They reward timing and structure. When gold confirms a sustained trend, silver often follows with acceleration. That phase shift is subtle at first and then sudden. We are now in the window where that transition is becoming increasingly visible. The industrial demand component of silver is frequently underestimated. Silver is essential in sectors tied to long-term global trends such as energy transition, electronics, and advanced manufacturing. These are not short-term fads. They are structural shifts that require sustained material input. As demand becomes more consistent and supply struggles to respond quickly, the market tightens. In a thin market, tightening conditions don't remain hidden for long. They surface through price. At the same time, silver's monetary identity is being rediscovered. When investors begin to question purchasing power and long-term currency stability, they don't just turn to gold. They look for alternatives that offer both scarcity and upside. Silver fits that profile, especially when it is perceived as undervalued relative to gold. That relative valuation dynamic has historically played a major role in silver's strongest rallies. When that gap begins to close, it often does so rapidly. Volatility is not a flaw in silver. It is a feature. Volatility is what allows silver to outperform during expansion phases. Once momentum takes hold, price can move far faster than most expect. This is why timing and preparation matter more than prediction. Investors who wait for confirmation often find that the opportunity has already passed them by. Silver doesn't offer gentle entry points during strong trends. It moves decisively. From a behavioral standpoint, silver rallies tend to catch the market off guard. Sentiment shifts quickly and positioning can change in a matter of weeks rather than months. That creates feedback loops where rising prices attract attention, which in turn feels further by. These phases are uncomfortable for skeptics and exhilarating for those who recognize the setup early. The key is understanding that these moves are not random. They are the result of long periods of compression followed by release. Another important element is silver's correlation behavior. During certain phases, silver behaves like a risk asset. During others, it behaves like a safe haven. When those roles begin to overlap, the market enters a unique state where silver benefits from multiple demand drivers simultaneously. That convergence is rare, but when it occurs, it can redefine price expectations very quickly. Supply dynamics add further pressure. Silver production is often tied to mining operations where silver is a byproduct rather than the primary focus that limits the ability of supply to respond quickly to rising prices. Unlike assets that can be produced at will, silver supply is constrained by geology and economics. When demand increases faster than supply can adjust, price becomes the balancing mechanism. What we are seeing now is not the peak of excitement. It is the early recognition phase, and many investors are still hesitant, still waiting for reassurance. That hesitation is part of what allows trends to continue. Markets really top when participation is limited. They top when participation is excessive. Silver is not there yet. The takeaway is simple but often overlooked. Silver's strength does not need to be dramatic to be meaningful. It needs to be persistent. As long as structure remains intact and demand drivers continue to align, the potential for outsized movement remains on the table. This is not about chasing volatility. It's about recognizing when volatility is preparing to work in your favor. The key thing to remember is this: